So when we're talking about different investment strategies, typically what we would be talking about such things as asset allocation, and there are other investment alternatives as well. But starting with asset allocation, it's you're spreading your assets over a number of different categories so as to lessen the risk, and the time factor comes into play, meaning that you're going to buy, continue to make purchases over a period of time. So if the value goes down, you would be able to buy more. If the value goes up, the value goes up. You won't be able to buy as much, but the value of your investment is going up. So that's what we mean by kind of asset allocation, spreading it out over several different types of investment to lessen the risk. And the longer you do this, the better off for increasing your returns. Again, that's what's called that asset allocation. So the investment period, we're looking at it in terms of risk level. So low risk, cash, CDs, money market mutual funds, U.S. government bonds. Low risk, low rate of return. So U.S. securities, select corporate, safety, and income. So you're getting some income from this, and you're still getting a relatively low rate of return. Growth stocks, growth-oriented mutual funds, rental properties. There's much more flexibility. There's higher risk, but there's a greater rate of return. Speculative stocks and other high-risk investments. There's an opportunity for a much higher rate of return, but you're also incurring much more risk. You're taking on much more risk, if you will. So when we talk about stocks and bonds, what we're looking at here is that the stock or equity financing. The equity capital is the money that a business obtains from its owners. Stockholders buy shares of company stock, so you are an owner of the company. The stockholders are owners and they have a share in the success or the failure of the company. We won't go there, but a corporation is not required to pay any sort of the money, repay the money back. It's not a loan. It is you have an ownership share in the company, and if you want to, you can always sell those shares of stock and leave. So it's ownership in that company. So again, the corporation is under no legal obligation to pay dividends to stockholders. They may end up retaining all those earnings within the framework of the company or dispersing it some other way, like as in terms of profit sharing to employees or to or management, if you will, as well. So you're dependent upon that, and if you always have the option to do what? To sell your shares of stock if you don't like the way the company is operating, is functioning. Two basic types of stock, common stock and preferred stock. The common stock is again the largest one, but when dividends are paid, common stock is the last in line, if you will. Preferred stock comes first. You don't have voting rights with preferred stock, whereas with common stock you do. But again, it's that ranking, if you will, so far as paying where you are at so far as being paid out of the company, if you will. It starts with that, on the debt side, the bond side, and then it goes to preferred stock and then common stock. This is the last part that is going to be paid, if you will. Long story short, onward we go when we talk about bonds. Corporate bonds are a loan to a corporation, the government, or a municipality. Government being at the federal level, or municipality being at the state or local level. Bondholders are receiving, certain payments over a period of time, interest payments, and the principal is repaid at maturity over a period of 1 to 30 years typically, and it all depends upon what the terms are of that loan, really, how it's going to be repaid. Bondholders can keep the bond to maturity or sell it at any point along the way, typically. You can sell these bonds and they'll sell at a premium or at a discount, but the point again is that they are convertible for the most part, unless they're not convertible, but that's another story altogether. So one of the problems with investing is that it's hard to go out there and diversify, on your own, buying shares of stock in different companies, whether we're talking about the actual cost associated with that or the difficulties in doing your own analysis. Instead, what you can do is you can opt to buy a mutual fund. A mutual fund is, again, it's pooled resources, and you would have a professional person out there managing the fund, and they're the ones that buy the shares of you. So you buy shares of stock, if you will, in the fund, and the fund itself goes out there and buys shares of stock or bonds or what have you from the various entities that are out there, whether we're talking about private or public concerns. They would be buying from, uh, so their role, of course, is to help you in terms of reducing risk, in terms of diversification. The funds themselves can range from very conservative to extremely speculative, and matching your needs, again, with the fund's objectives. The responsibility for choosing the right mutual fund is based on your evaluation of a mutual fund investment. You can pick different types of funds, index funds, etc. But again, that's for another discussion. Next, of course, we're talking about with real estate. Real estate can increase in value. But it all depends, right? This is, again, a very risky proposition. So most important thing to factor is that the location. Before you make that decision to buy any property, is the property priced competitively with similar properties? So you really have to know your business. This is another aspect of buying real estate, is that it takes a lot of work involved. So what type of financing is available, if any, for the property? How much are the taxes? What are the conditions of the building and the house and the immediate houses in the immediate area? What are the present owners selling? Why are the present owners selling the property? Always a very good question to ask anyone that's selling you anything, is that why are they actually selling that property? Is there a chance that the property will decrease in value? Yes, there's always that option. There's always that possibility. So again, real estate can be very, very risky. You just have to, again, know what you're doing your research up front. And it's, again, tends to be much more of a long-term investment, keeping that in mind, right? So your role as the investor is that you have to do your homework. You have to evaluate potential investments, monitor the value of your investments. Again, if you have your investments, it's not that you're looking at them on a daily basis. You don't want to do that. Step back and do your homework up front and do it and then circle back every now and again, meaning every few weeks maybe. But it doesn't have to be every darn day. It'd drive you crazy doing that. So keep accurate and current records, and seek assistance of a certified financial planner if you don't feel comfortable in doing this yourself. And it does not hurt to ask, okay? Consider the tax consequences of selling your investments, whatever those might be. If you have tax-deferred savings in an IRA, keep in mind that if you're under the age of 59 and a half, for example, then you will have to pay a 10% penalty to do that, to sell those investments, to divest, if you will, to liquidate your investment. So onward we go. So the various sources of financial information that are out there, of course, there's internet. There's a lot of information out there, such, going through Yahoo, Bing, Google, etc. Lots of others, newspapers, which we no longer see anymore, but there are news programs that are out there to kind of for you to build your confidence in this and to gain an understanding. This is all a learning process, and it takes a long time to develop a knack for this, if at least having an understanding, a basic understanding of what's happening out there in the markets is important. Business periodicals, reading corporate reports, investor services such as, again, Value Line, Mergent, Morningstar, lots of other resources that are out there that are always available through cable, CNBC. through Fox Business and other channels that are available out there for you to gain some investment understanding, if you will.